Hello and welcome. We're diving into the financial system today, and we're going to tackle a really big question. Seriously, think about it. How does the cash you put away in your local bank branch somehow find its way to fund a massive construction project hundreds of miles away? It seems totally disconnected, right? Well, it's not. It's all part of this huge, interconnected global network. And in this explainer, we're going to pull back the curtain and show you exactly how those dots connect. And to get our heads around this, we're going to break it down into four simple parts. First up, we'll look at the why, the whole purpose of the system. Then we'll dig into the what is actually being bought and sold. After that, we'll meet the who, all the crucial middlemen that make it run. And finally, we'll cover the how, as in how you can actually make a move in this world. So let's get into it. Okay, so first things first, let's start with the most fundamental question there is. Why does this incredibly complex financial system even exist? What is it all for? Well, it really just boils down to six main jobs. It lets us save up for the future, for things like retirement or a down payment. It also lets us borrow money for big things we need right now, like a car or a college education. For businesses, it's basically the engine for growth. It lets them raise money to build new things. It also gives us tools to manage financial risk, helps us exchange currencies to trade with other countries, and, of course, it provides a place where people can trade based on information and ideas. So how does the system balance all of that? You can think of it like a giant scale. And at the center of that scale is what we call the equilibrium interest rate. It's really just the price of money. If tons of people are saving but not many are borrowing, the price, that interest rate, goes down. But if everyone wants to borrow and there's not enough savings, that price goes up. The whole system is just constantly trying to find that perfect balance point. All right, so now that we know why this system is here, the next question is, what's actually being traded? What are the actual building blocks of the entire market? The big general term for all the stuff being traded is securities. That's it. You can just think of them as contracts that have some kind of financial value. And even though there are thousands of different kinds, pretty much all of them fall into just two major buckets: debt and equities. And this is maybe the most important distinction of all. It really comes down to one simple question. Are you a lender or are you an owner? When you buy a debt security, like a bond, you're a lender. You're loaning your money out with the promise you'll be paid back with interest. It's generally lower risk. But when you buy an equity security, like a stock, you're becoming an owner. You're buying a little slice of a company. Now, that's definitely riskier, but the potential upside, the potential reward, is so much higher. So let's run through the most common types you'll see. Bonds, like we said, are just loans. Stocks make you an owner. Then you have things like mutual funds and ETFs, which are just brilliant. They're basically pre-made baskets of different stocks or bonds that you can buy all at once. It makes diversification super easy. And then you have derivatives. Now, these are a bit more complex. They're like side bets whose value is tied to the price of something else, like a stock or a commodity. Now, here's another key concept: the difference between the primary and secondary markets. The primary market is where securities are born. Think of a company's initial public offering, or IPO. That's when it sells brand new shares to the public for the very first time to raise money. But the secondary market, like the New York Stock Exchange, is where you and I trade all those existing shares with each other. In that case, the money just moves between investors. It doesn't go to the company itself. Okay, so we know why the system exists, and we know what's being traded. But who actually makes all of this happen? Let's meet the architects and the engineers of the financial world. I mean, you can't just call up a company and ask to buy one share of their stock, right? You need someone in the middle, a go-between, to connect you to that giant global market. So who are these people? Well, the two most basic roles are the broker and the dealer. A broker is your agent. They work for you, going out into the market to find someone willing to sell what you want to buy. A dealer, on the other hand, is what we call a principal. They trade with you. They sell you shares directly from their own inventory or buy shares from you for that inventory. It's a really critical difference. But there's so much more going on behind the scenes. Investment banks help companies with those big IPOs. Exchanges, well, they're the marketplaces themselves. Clearinghouses are like the official referees of the financial world. They make sure that when a trade happens, the buyer gets their shares and the seller gets their cash. No mistakes. Then you've got securitizers, who bundle up assets like mortgages to create new securities. And finally, custodians are like super secure vaults holding onto your investments for you. All of them together form the essential plumbing that makes the whole system work. Okay, we've arrived at our final section. We've covered the why, the what, and the who, so now let's talk about the how, the basic moves you can make to actually get involved. Really, there are only two fundamental ways to take a position. The first one, going long, is what everyone thinks of. You buy something because you think its price is going to go up. Easy. Your risk is limited to what you invested. But going short is the complete opposite. You are betting the price will go down. You actually borrow a stock, sell it, and then hope to buy it back later at a lower price. But here's the catch, and it's a big one. If you're wrong and the price skyrockets, your potential losses are, theoretically, unlimited. It's a high-risk strategy. Now, when you're ready to buy or sell, you place an order. A market order is basically you shouting, "Get me in now, I don't care about the exact price." It's all about speed. A limit order is more precise. It says, "I only want to buy at this price or better." It's all about price control. The trade-off is pretty simple. A market order will definitely get done, but the price might not be exactly what you saw a second ago. A limit order guarantees your price, but it might never get filled if the market moves away from you. And finally, let's talk about a tool that can be incredibly powerful, but also very dangerous: buying on margin. This is simply borrowing money from your broker so you can buy more securities. We call this leverage, and it is a classic double-edged sword. If you're right, it can magnify your gains in a huge way. But if you're wrong, it will magnify your losses just as fast, and you can end up owing way more than you started with. And there you have it. That's the financial system in a nutshell. It's this huge, complicated machine, but at its heart, it has a very simple and powerful purpose: to connect the people with savings to the people with big ideas. So yeah, that money in your bank account really can help build the next skyscraper or fund a breakthrough cure. Which leaves us with just one last question to think about. What's the next big idea you think is worth funding?